now move on to our next session, which is on purpose-driven investment. We have Mr. Achin Khanna, Managing Partner, Strategic Advisory, Hotelivate, moderating this panel. Achin heads the firm's strategic advisory practice. His experience in consulting field ranges from feasibility studies to strategic consulting both in India and internationally. He's joined on stage by Mr. Alexandria Fernandez de Oliveira, Chief Investment Officer, Manufacturing, Agribusiness and Services Department, Southeast Asia and Pacific, IFC, and Mr. William Huston, General Partner, Bay Street Hospitality. Please give them a round of applause.
Okay, thank you, Trisha. Beyond. Ladies and gentlemen, good afternoon. William, Alex, welcome.
Thank you.
Let me begin by stating a little bit of the obvious. Most investment panels and investment discussions, for that matter, circle around the essentially given assumption that investment is done with the eye of return on investment, right? Why do you invest? To make a return. That's the underlying principle of most investment decisions, not just in hospitality, but even generally. I think that the topic of discussion with these gentlemen today is that all there is to investment? And are there certain additional principles to investment that can also be applied without compromising the ROI? And words that come to mind are purpose, or impact, or inclusivity. There is a school of thought, and there are investors, including the gentleman sitting on stage with me today, whose investment philosophy circles around optimum ROIs with a purpose. And we're hoping to discuss that today with Alex and with William. So to get things going, Alex, may I recommend and request that you start with maybe a 30-second introduction on investment with purpose and what that means to you.
Excellent. Well, first of all, thank you for the opportunity, the invitation. It's been a very interesting couple of days for me here. Maybe I'll take 10 seconds just to introduce myself because it is a bit relevant in the context. I've been with IFC. IFC is the private sector arm of the World Bank Group. I've been with IFC now for longer than I care to remember, but more relevant to today's discussion, in Asia since 2016. I spent several years in Hong Kong, a couple of years in Singapore after that, and I've just relocated to Jakarta in the beginning of this year, actually on the 1st of March. I come to this job in Jakarta with a lot of healthcare experience. I've been leading our investments in the healthcare space in Asia for 10 years. But my role here in Indonesia is quite different. I'm responsible for investments and relationships across a wide range of industries. Anything that's essentially not a bank or traditional infrastructure falls within my group. That includes services, that includes hospitality. So I say this because I'm not an expert in the industry. My industry-wise, I have much more of a background in healthcare. But I've been in banking for a long, long time. Now very quickly to answer your question, IFC is the private sector arm of the World Bank Group, so we share the same development objectives with the World Bank itself, but we do it by working with private sector only. So all of our investments, financing, equity stakes, are in private companies with no government subsidy, purely private. And I think that whenever we take investments, debt or equity, and we can do both, to investment committee, I'd say that in general, we split the time between what we expect in terms of financial return, viability, etc. We spend as much time on that as we do with what we call development impact, and that's the answer to your question, which is good that comes to a country, a market, a region beyond the financial return to investors, whether shareholders or lenders, the story changes a little bit investment by investment. It can be as simple as creation of new jobs, but it can also be a transfer of know-how, technology, introduction of new services. But the point is, there has to be a story, there has to be a sense of broader good than just the financial return to investors.
Thank you. Moving on to you, William, and on the same theme, your company is called Bay Street, and there is something I understand called BII, or the Bay Impact Index, that you follow as an investment philosophy. And my question to you is, how is BII constructed, and how does it align, for example, with an IFC kind of organization when you take your investment decisions?
Sure. So I'll also share a bit of background for context on the question. Bay Street, we started out as a wealth management firm where we provided asset management for families in the San Francisco Bay Area, and we sold that business last year. And what gets me excited about looking at Asia as it relates to like a hospitality market is I can remember my first time landing in Asia. I went to the Philippines. I owned call centers there for about 10 years. And my first time in Manila, I was looking over a bridge, and I just remember this getting full of emotion and excitement when I saw how many people there were and how many jeepneys and how many mopeds and there was just so much energy and activity. And that left a deep impression on me. And I think that as investors and as guests experiencing, there's a superpower that I see in Asian hospitality that can almost be overlooked if you're focused too much on the numbers, and that is taking this sense of gratitude, taking this sense of belonging and feeling welcome, and then seeing how that translates into outperformance. And an example I like to share is, in this part of the world, when you meet someone, you put your hands together, or in certain parts of Asia, you bow when you see someone. And I can remember distinctly the first time where I experienced that, and it wasn't just someone going through the motions. I actually felt like I was sharing in this gratitude that they had in the property, that I was welcome there, and that I had a sense of belonging. And I think if all of us close our eyes and we think about where did I experience the best hospitality ever, we don't remember, the hotel paintings or the color of the pillows. We remember how these organizations made us feel. And even last night, right, when we went to each of the properties, all of them had the right vibe, the food was amazing, but there were certain organizations, from my view, that went above and beyond to make me feel that they were grateful that I was there, that they were welcoming me into their space. And if anyone's read a book by Will Guidara called Unreasonable Hospitality, he talks about, he's the guy who started 11 Madison Park. It was the #1 restaurant in the world right before COVID, and he ran front of house. And he talked about how hospitality organizations have the opportunity to put these processes and systems in place that make guests feel that they're experiencing this one-off amazing experience, but it's really just the right training. And it's finding these organizations that are delivering the best-in-class hospitality. And that really excites me. I think if you do that, you're going to end up with people who come back, who talk about the experience that they had. They're going to spend more money, and that hospitality is going to translate to outperformance in the long term. So as it relates to the index score that we have, IFC's mandate, they're looking at second and third tier cities, emerging markets. There's a concern for social dividend, not just financial return. And because of that, our view is that how do you do that, right? There's lots of data sources that provide ESG data, that provide financial data. And so what we've done is we've taken something called a composite score, and a composite score is basically a number. And that number is made up of lots of data sources together. So for our composite, we're looking at investment feasibility, we're looking at the strength from a governance standpoint, and we're looking at strength from a impact standpoint. So for investment feasibility, it's all the things you would imagine. It's market risk, repatriation risk, percentage of tourism relative to GDP. You're looking at number of new airports, number of new tourist arrivals, all the big data. On the governance side, you're looking at, the transparency that's being provided from the sponsor side of a co-investing. And on the impact side, you're looking at the percentage of people being hired in these second and third tier cities relative to the benchmark, the percentage of women and eligible young adults that are being given jobs in these places, the percentage of cultural workers that are able to provide their art in these hotel spaces where people are paying a premium for their service. And I think that what ends up happening for organizations like IFC, if you take all of that disparate data and then distill it down to a score that you can understand, you're able to, at scale, deploy capital into hospitality opportunities, not just based on profitability, but that are also inclusive, that are focused on sustainability, and that are, you go from having the intent to be able to deploy capital to actually seeing like measurable and underwritable impact on a day-to-day basis.
Got it. Thank you. Alex, let's go one level deeper now. Let's talk some numbers. Now, there's two things that are possibly undisputed. One, our industry, hospitality, is long on gestation. It takes a while to get your money back. And two, IFC and the World Bank's mandate being more than just ROI, and you wanting to make a genuine impact comes with the inherent risk of entering markets or entering projects that may inherently have their own risks. How do you mitigate both these challenges?
Yeah, it's a balance. There's no strict formula. We do invest out of our own capital, so we don't have on the debt side or on the equity side, we don't return money to LPs, to other investors, which allows us to be a bit more patient. We do essentially fund ourselves from the returns on the investments we make, so we do need to recycle our capital, whether that is eventually selling equity stakes in different companies or hoping that our loans are repaid, et cetera. So we are commercial in that sense. But we are also able to ex ante budget a little bit of a longer gestation period for a project. And also, if market conditions aren't right, we also have the flexibility to wait a little longer to exit. Like, we don't have a date certain by which we need to return capital to investors. We do measure, so we look at every investment individually, both on the financial side as well as on the development impact side. But we also manage a portfolio, right? So last year, we will have invested north of $1 billion into properties in Asia, not only hotels, but including hotels, and this is across Southeast and South Asia. It tends to work out on a portfolio basis. There are some investments where we think it looks really good financially, and maybe the company has a lot of access to capital markets. Maybe the development impact is not great, but financially it's very attractive. And the flip side, there are things that we do that we know are borderline in terms of financial returns, but the potential for impact is huge, and we will do some of those as well. And on balance, things work out, and there isn't a fixed formula between both. Having said that, we would not make an investment where we cannot claim some level of impact, and we will not make investments where the likelihood of losses are big. But in between the two, I don't know, extremes, there is a range of things that we do that are more financially attractive and sometimes more developmental.
Thank you. William, I'm going to flip that a bit. ESG as a concept, environmental sustainable goals, are a big deal across industries and across economies globally today and are becoming more and more so. There's a school of thought that when a project is ESG compliant, that's more a tick in the box exercise than actually an investment philosophy. Would you buy that argument, or do you think there is genuine takeaways from being ESG compliant?
I mean, I think it can be a tick-the-box thing for some investors, but I also think part of becoming an exceptional investor is learning from your failures, seeing something not work out, kind of what Alex shared, like at the portfolio level it works out, right? And being able to learn from these compounding experiences to make better investment decisions. And so my view is, instead of just looking at, did the investment work out or not, or did I hit my IRR target or not, over time, you have the opportunity as an investor to really ask yourself, am I investing in the sort of people that have earned the right for this capital? Am I investing in the right sort of places that need, these concessionary loans and things like this? And is there the right, from an intent standpoint, am I investing with purpose and having that long-term view? Because if so, it kind of goes beyond whether or not you check the ESG box, because that's not really what the box is there for, if that makes sense, right? Like, it's not really like, did you check the box? It's more, how do you want to express your investment thesis? And I think over time, just as all of us can tell as a guest in a property when we feel welcome and we have this sense of belonging, I think institutional partners seek out managers where they see a certain level of discipline that has been rooted in the successes and failures throughout long periods of time, where they can now make better investment decisions for their investors moving forward.
Agreed.
Can I add one
Please.
quick thing on this note? So I tend to agree, but it's also been my experience that investors, for example, will not pay more or receive less, in the case of loans, for sustainable investments. We have a lot of examples on that front. I am coming from actually leading a couple of very large financings for a couple of the largest developers in Thailand. And this was a big deal. It was a big deal for us. We helped them set up the sustainability framework. This stuff is, third-party verified. It was the first time that a developer in Thailand issued sustainability-linked bonds. So it was a bit of something. And the truth is, in terms of spread, the coupon the company paid didn't really make a difference compared to their non-sustainability linked bonds. So there was no premium for the company, for the issuer, by making the financing sustainability linked. On the other hand, and by the way, together with our capital, we have a ton of resources to help clients enhance a number of aspects of their business, but especially sustainability. And I think the flip side of this is that a lot of these interventions, whether it's making buildings more energy efficient or reducing waste, et cetera, these things seem to self-pay very quickly. And so that's a good thing. You're not asking the owner or the operator to sort of, invest money just for, which has value, but just for making things more sustainable. In themselves, these interventions are typically net positive from a financial standpoint as well.
Sure. In fact, you've partially answered the next question I did want to ask you, and it was a two-part question, so I'll table it with you. And the first part was, which of these ESG metrics, which you touched upon, carbon footprint, local employment, governance, or something else, which of these matter to you most from an investment philosophy? And part two, does climate risk and over-tourism factor into your decisions?
They do. Let me answer the first one first. All of them are important, but if I had to put one, a bit ahead of the others, it would be employment. And that's, I think, the key attraction to hospitality for us is employment generation. I have to say, I was encouraged in many of the sessions earlier today in all the talk about wellness. I don't think it's something that we've considered, but given my background in healthcare, interesting synergies there. Employment is the one driver for us to invest in this industry, but the others are important too. Except, making infrastructure, hotels, etc., more energy efficient. That's true, but we do that commercial property, residences to some extent, retail, etc. It's the employment is key. My sustainability climate is up there. The one that you did not mention, but I do want to bring it up, are linkages to local supply chains. I think one of the beauties of this sector is the ability to connect with local producers, whether it's agri, whether it's furniture, whether it's other services. The linkages to local supply chains, that's something very important to us. And again, we do have resources that we can deploy to sort of help our clients engage more productively, let's say, with local supply chains.
Okay, William, the next one actually is for both of you, and I'll start with you. Interlinked question. From Bali to Bangkok, all of Southeast Asia, what are those 2 or 3 markets that you think are white spaces, if I could call them that, or underserved markets that you would be open to looking at? And as I said, that applies to both of you. I think equally important is an attached question. There's a fair few investors / developers in the audience today. What should they be doing to attract your investments in the markets that you speak of?
So I think, our process is we have a platform that helps us identify which markets make sense to continue the diligence process. But once you've identified those markets, you can't take that same one-size-fits-all to finding partnerships, right? So there's certain developers, operators, asset owners that might be a good investment, but that doesn't necessarily mean they're a good investment for us and our team and the approach that we're looking to pursue as a team investing in this space. And so I would say, at least for me, it's not so much is there one particular market that I find more compelling than another, because even if that's the case, the next step after identifying a market like that is to determine who are the organizations, both at the government level that we work with, as well as at the private sector that we work with, and what are the exit opportunities that are there? Because we are a fund, so yes, it can be patient, but we also have to provide an exit to our investors. And I've found markets where it can be a very compelling investment opportunity, but for example, it can be very difficult to work with the government. It can be very difficult to find private organizations that are large enough to take the capital that can have a later liquidity event. And so I would say it's not just, pick a place, it's also make sure you pick a place that has the right type of partners that you can work with.
Okay, Alex, you got some names?
Sure, very quickly. Look, the development side of us, IFC, would love to do more in places like Laos, Cambodia. We were actually looking quite a bit into Myanmar, not recently, PNG, places where there's a bigger need, frankly. But as I said in the beginning, we also have to balance that with the financial viability. and also size. I'll make a comment about that, getting back to this issue of what owners and operators should look for when working with us. So I would say right now, Thailand is still important for us on the property side, Vietnam to some extent, and not just because of my arrival, but we're keen to do more in this country. I'm Brazilian. I hold myself to very high standards in terms of beach quality.
Yeah.
And Indonesia is just amazing. This country is incredibly beautiful. The culture, the people, it punches, in my opinion, well below its weight in terms of tourism potential. It's true that doesn't come alone. You need the airlift, you need the infrastructure, and this stuff is not easy, but the potential in this country is, in my opinion, second to none. Look, first thing in terms of approaching IFC, just approach us. We'll engage with anyone and everyone. When potential opportunities go too much to the small side, it tends to get difficult for us. I think deploying anything below 30, 40 million US, whether it's debt or equity, becomes hard for us. We have a strong preference for not financing stuff on our own. It's part of our mission to catalyze additional capital from other sources. It's not a balance sheet issue, it's just what we were designed to do. So small investments tend to be an issue for us. And look,
sorry, I'm interrupting. Could you quantify that? I mean,
yeah, I think for us to write checks below 30 or 40 million US is hard. Ideally, we'd like to do a lot more than that, and preferably if we can crowd in even more investments from others. I think things that are too niche, where the development impact is a bit limited, high-end residences, for example, it's something that I think we'd struggle to make a case on the development side. We tend to shy away from those as well. And I will underscore that there are different avenues to engage with us, whether it's EDGE accreditation for those of you who are familiar, but sustainability of buildings. We have a number of advisory resources, gender, I mentioned supply chains. Sometimes that's an easier avenue to start an engagement than in a conversation.
Sure. So we've got just a couple of minutes left. I want to do one final question with both of you, and forgive me for putting you on the spot a little bit, but maybe we try and extract some specifics from both you gentlemen. Is it a fair assumption that if an investment opportunity qualifies as worthy, that the developer may hope to achieve, say, a couple of 100 basis points discount on market interest rates, for example, maybe extra 5 years of repayment? I know I'm throwing you on the deep end on this one.
No.
But both of you, any thoughts?
No. Sadly, no. And that's a popular misconception. Although part of the World Bank Group, we are by design meant to be commercial. We actually would get in trouble if we were seen to be undercutting private sources of capital. The flip side is that we're supposed to be market-based, and to a large extent we are. So we're not supposed to be more expensive than anyone, but there is no subsidy. What I will tell you up front, our due diligence process, and this is sometimes a hindrance for us in many countries, our due diligence process is very involved and very detailed. We don't cut corners, and that is sometimes a challenge, not because sponsors don't care, but because compared to the local bank who's had a relationship with the company for decades, and it's kind of almost a handshake and the deal is done, that is not the same for us.
Got it. William, some closing thoughts on the same one?
I'd say for us, we're a fund, so we have to return capital to investors. But I would say there is a little caveat where we might not be able to, give some sort of discount or something to this effect. We're not passive investors, right? So we're strategic capital. And I spoke earlier about sort of the impact of what can go on post-investment. And one of the, I think, opportunities for outperformance is what happens after this rigorous diligence process, after the capital has been deployed. And for us, what we've identified is there's certain operators. This is why we teamed up with Tommy Lai and his team at Elevate Hospitality to make sure that as we diligence these opportunities and deploy the capital, that we're able to also steward these investments and add our subject matter expertise and all of the relationships that we have in the hospitality space to continue to add value beyond just the capital that we provide. Yeah.
Got it. Splendid. Gentlemen, I learned a few things. Thank you. Audience, I hope you found value in this as well. Thanks again.